Right, now let's look at some of the jargon. A lot of these terms might be confusing at first, but don't worry, we'll get through them word by word. And relax, it is the first time you hear or see some of these words, so please do not feel scared. These are just the terminology that you will need to understand so that you are more comfortable and you'll be able to trade shares with a lot more ease. Let's get going. Some of the words to know are, for example, a primary market, or a public company, or a flotation, or an IPO, a bull and a bear market, going long and going short, closing out. These are just terms that are used by participants in the market to describe certain things that are taking place. What is a public company? A public company is one that is listed on the Securities Exchange. It's traded and it's tradable, so its shares are available to trade and you can buy and sell them. The public can buy and sell those shares. Securities. Security is not a security guard at Sandton City. No. It's a share or an instrument that is tradable or traded on an exchange. A primary market. A primary market is where a private company goes to issue new shares for the first time, and a private company becomes a public company by selling its shares in the primary market. Who are the participants in a primary market? Well, some of the big asset managers who manage your retirement funds and your portfolio managers. A secondary market. Now this is where you will be trading. A secondary market is where the issued shares are traded on the exchange, and those shares are bought and sold by people like yourselves and myself who are in the public domain. Liquidity refers to how many shares are available to be bought and sold. A highly liquid share is a share that is easy to trade, and there's lots of buyers and lots of sellers. So as a buyer, you're more comfortable with a share that is highly liquid, because when you want to sell, you'll be able to find sellers, and vice versa. A bull market. Now this is generally a positive market. The markets are positive, participants are positive, there's good news, there's good strong financial results out of the companies, and in a short period of time, the market is trending upwards and shares are moving up, and it's called a bull market. A bear market is the exact opposite. Everybody's depressed, everyone is sad, there's sad earnings, sad announcements. Just generally, over a certain period of time, share prices are declining versus rising. Now this is known as a bear market. Volatility. This relates to how quickly a share price moves. A highly volatile share is regarded as a risky share because the price movement happens over a short period of time. Now, a low volatile share is regarded as a stable or a less riskier share. So a lot of participants use volatility in line with a risk that they want to take. So if you want to take on a higher risk, you take on a highly volatile share. If you want to take on a low risk, you take a low volatile share.